Welcome to the Deep Dive. We're here to cut through the noise and get straight to what matters in finance. Today, we're tackling the first quarter 2025 earnings call from Eurobank Holdings. We'll break down their performance, look at the key numbers, and really unpack what it all means.
Yeah, let's jump right in. So Eurobank reported adapted net profits of $348 million for Q1. And importantly, their return on tangible book value went over 16%.
Over 16%, that's quite a key metric, isn't it? Shows efficiency.
Exactly. And tangible book value per share landed at 2.39.
Okay, those are the headlines. What else stood out in the financials this quarter?
Well, net interest income, NII, saw a pretty healthy 12% jump year on year. That's their core lending profit.
12% is significant.
It is. And season commissions were also strong, up 25% compared to last year. So good fee income there. Core pre-provision income, basically their underlying profit before loan loss provisions, that was up 5% year on year.
So core earnings power is growing. I did see operating expenses in Greece were up, though.
That's right, up 6% specifically in Greece. But like you said, that core pre-provision income growth helped balance it out.
And what about risk? How are they managing potential loan losses?
Their cost of risk ratio looked well under control, came in at 59 basis points, so 0.59%, which fed into a core operating profit of $426 million. That's also up 5% year on year.
Okay, solid performance. You mentioned Greece, but how important are their operations outside their home market?
Hugely important. Actually, their regional operations generated $184 million this quarter. That's 53% of their total profits. Really shows the strength of that diversification.
Wow, over half. So that strategy is clearly working.
Yeah.
Any specific regional highlights?
Definitely. Cyprus, which now includes Hellenic Bank, of course, delivered $120 million in net profit. And Bulgaria also put in a solid performance with $55 million net profit.
Okay, Cyprus and Bulgaria standing out. And loan growth.
Loan growth kept up its strong pace. They added a net $1.2 billion in loans just in Q1.
$1.2 billion in one quarter.
Yep. Translates to 10% growth year on year. So clearly, demand for loans is there.
That's pretty robust. But I noticed deposits actually decreased in Q1. What's the story there?
Yeah, deposits were down by $1.5 billion, but you have to put that in context. Q4 was exceptionally strong for deposit inflows, so this looks more like a normalization.
Ah, okay, so maybe not a red flag, just balancing out after a big quarter.
That seems to be the read. And importantly, asset quality looks good. The NPL ratio, non-performing loans, is still below 3%, and coverage for those NPLs is strong, up at 89%. So they seem to be managing credit risk well.
Good to hear. What about their capital position? How financially strong are they looking?
Very solid. Their CET1 ratio, that key measure of core capital, was 15.5% at the end of March. And the total capital ratio was even higher, 18.9%. So well capitalized.
And strategically, the Hellenic Bank deal seems to be moving forward.
Yes, the mandatory tender offer is done. Now they're just in the process of the squeeze out for the remaining shares. They expect that to wrap up sometime in Q3.
So integration progressing. Any other strategic moves mentioned?
Yeah, they mentioned their IT rationalization and the staff reduction through the voluntary exit scheme are proceeding as planned. Also, the sale of their CNP insurance business in Cyprus, that was completed in April, just after the quarter ended.
Okay, so despite everything going on globally, they're reaffirming their full-year target.
They are. Still aiming for that return on tangible book value of around 15% for the full year 2025.
Right. Let's dig a bit deeper then. The call mentioned some developments in Paris early in the year. How's that broader macro picture affecting things?
Well, those events definitely stirred things up. We've seen more international tension, which impacts trade, creates market volatility, and it's contributing to a bit of a slowdown in global growth overall.
And how's Europe responding to that?
We're seeing a shift, particularly in places like Germany, towards more, let's say, targeted stimulus measures from governments. And there's, potential for wider EU public spending increases to kind of prop up activity.
Okay, but your bank's footprint is more Greece and the surrounding region. How exposed are they to this global turbulence?
That's a key point. Greece and the other countries they operate in seem less directly exposed than, say, the core Eurozone. Their links to the U.S., for instance, are seen as manageable.
So potentially more insulated.
Relatively speaking, yes. Projections still show growth in Greece, Bulgaria, and Cyprus remaining stronger than the EU average. That regional focus seems to be a buffer.
And that seems reflected in their trade finance activities, too. They mentioned strong expansion there.
Exactly. Q1 saw robust trade expansion. That was driven mostly by investment activity in Greece and just general economic momentum in Bulgaria. And the expectation is that this should, continue through the year.
Okay, let's talk interest rates. The global picture you described sounds like it might change the outlook for the ECB.
Absolutely. The current thinking, driven by this global uncertainty, is leaning towards potentially faster and deeper rate cuts from the ECB than maybe we thought a few months ago.
Right. Faster and deeper cuts. Now, that usually puts pressure on bank NII, doesn't it?
It can, yes. Lower rates generally squeeze margins.
But Eurobank kept their 2.5 billion NII guidance for the year. How are they squaring that circle?
It's interesting. They acknowledge that the terminal rate might end up lower, maybe 1.5% instead of the 2% in their plan, but they expect faster growth in loan volumes and also in their bond portfolio to offset that.
More volume to make up for tighter margins.
Essentially, yes. Plus, they anticipate that the contraction in corporate lending spreads the gap between lending rates and funding costs will slow down. They also gave a sensitivity number. A 25 basis point rate change impacts NII by about 35 million.
Okay, that makes sense. And that strong Q1 loan growth we discussed plays right into that volume expectation, right?
Precisely. That 1.2 billion organic growth in Q1 alone, that's over a third of their full year target already. And like we said, it was driven by corporate lending in Cyprus and, interestingly, mortgage lending in Bulgaria.
Mortgages in Bulgaria specifically.
Yeah, and they said April's figures suggest that trend is continuing, so the momentum seems real.
Okay, let's swing back to the other side of the balance sheet deposits. We know they dipped in Q1. Where did that primarily come from?
It was mainly corporate deposits, both in Greece and Cyprus. But again, context is key. It followed that really, really strong Q4. They said levels are mostly flat now.
So the loan to deposit ratio would have ticked up then?
It did. It increased to 67%. Still very comfortable, but reflects that shift.
Got it. What about their investment portfolio? Any changes planned there?
They have a target for their investment securities for 2025, around 23 billion. They're basically already there. So no major changes expected unless market rates shift significantly and create some, really compelling new opportunities.
That makes sense. Now, the Hellenic Bank deal, crucial strategically. How are the promised synergies panning out?
They're actually ahead of schedule, it seems. The 48 million synergies targeted for 2025. They said they've already realized.
Ready. How?
Through a few things. Funding efficiencies from combining operations, managing some existing Tier 2 debt, fees from an insurance sale related to the deal, and savings from that voluntary staff exit scheme. And they expect more cost savings to come as they integrate Hellenic Bank's back office functions.
So the integration benefits are flowing through. What about overall funding and capital management? Any key updates?
Yeah, their MREL ratio, that's the buffer for potential losses, hit 28.8%. That's already ahead of their June 2025 target of 27.8%. So they're in a very strong position there. Which means their net funding needs for the rest of this year are basically close to zero. So don't expect any major new debt issuance from them unless they decide to call an old, expensive Tier 2 bond they have.
Which bond is that?
It's a 950 million legacy Tier 2 bond with a 6.4% coupon. If they call that, they'd likely just replace it one for one with new, probably cheaper senior or Tier 2 debt.
Okay, so potentially optimizing their funding costs there. Yeah. And speaking of costs, what about deposit costs with rates expected to fall?
They expect deposit costs to track ECB rates downwards. So as the ECB cuts, their funding costs should decrease. And importantly, their overall NII guidance already factors in assumptions about deposit pricing, deposit growth, and of course, loan growth.
Right, it's all interconnected.
Yeah.
What about regulations? Basel worries is always looming for banks. What's the impact there?
For 2025, the impact is pretty small, just a 10 basis point hit to their CET1 ratio. And they said that was fully baked into the Q1 numbers. Longer term, out to 2033, the total expected impact is estimated at 56 basis points on CET1. Seems manageable.
Okay. Circling back to regional performance of Cyprus loan growth, what's the outlook for the rest of the year?
They're guiding for moderate loan growth in Cyprus for the full year 2025, but they expect most of that growth to come through in the second half of the year.
And the type of lending? Still mainly corporate in Greece.
Yeah, in Greece, corporates are still the main driver, though they did mention a slight improvement in mortgage lending. But Bulgaria is where you see the really significant mortgage lending growth right now.
Okay, interesting regional differences there. Finally, looking ahead just to Q2, anything specific investors should keep an eye out for?
Yes, one thing. Due to that SP Insurance acquisition in Cyprus, closing in April, they expect to book a negative goodwill item of over 30 million and also get a boost to free income of at least 20 million in the second quarter results.
Got it. Okay, let's shift gears. Time for our speculative segment. This is not financial advice.
Except.
So, we've heard about Eurobank's strong loan growth, beating expectations, especially that surge in Bulgarian mortgages. Combine that with potentially faster, deeper rate cuts in Europe, making borrowing cheaper.
Right.
And the fact that Europe's own funding needs are minimal.
Right. Well, thinking outrageously but plausibly, you could look beyond the bank itself. Maybe consider going long Bulgarian real estate developers, particularly those focused on residential building.
The play on the housing market there.
Kind of. The logic is EUROB is pumping out mortgages in Bulgaria. Lower rates could boost demand further. Maybe that fuels housing prices and developer profits. It's definitely a leveraged way to play the trends we saw in the earnings call, but without buying the bank stock directly.
Interesting angle. But what about the risks? The broader economic slowdown we discussed.
Good point. To hedge that, you might consider a small short position in a broad Eurozone ETF. It acknowledges those potential global or Eurozone-wide headwinds, even if Bulgaria or Europe-specific region looks stronger right now.
Okay, definitely food for thought. But let's stress again, this is purely speculative, not financial advice. Do your own research, always.
Absolutely. So wrapping up this deep dive into Eurobank's Q1, what's the takeaway? I'd say it points to a bank showing real resilience, strong underlying performance, despite, a pretty complex global picture.
Yeah, key things for me were that robust loan growth, especially regionally, their proactive management of funding and capital, being ahead on MREL, and just their confidence in hitting those full-year targets, even with the shifting rate outlook.
Agreed. It paints a picture of navigating challenges quite effectively so far.
So we definitely encourage you to dig into your bank's full results yourself. See how these pieces fit into your own view of the sector. What really stood out to you from this call? We'd genuinely be interested to know your perspective. Thanks for joining us for this deep dive into Eurobank Holdings Q1 2025 earnings.